So you are welcome to another session of management accounting. And in this session, we'll be looking at budgeting and budgetary control, which is a huge part of your management accounting syllabus. Now, budgeting constitutes about 15 to 20 marks of your exam. Okay, 15 to 20 marks of your exam. Now, one thing you must realize is that you can't do management accounting without budgeting, because ultimately, yes, we know that when a budget is put into per unit terms, no, so we end up with what we call what? Standard cost. Okay. So you can't do standard costing without a budget, right? You need budgeting. Budgeting is very important. Now, what is a budget? A budget can be defined as what? A plan quantified in monetary terms, or simply a quantified plan of action for an upcoming and accounting period. Okay, so a budget can be set from the top down, meaning from the top management down to your subordinate, or you, the subordinate, will set it and then it is given to a top level management. That is what we call the participatory approach, which is when you set and you send it to a top level. And we have the imposed style of budgeting also, which is where the superiors will set and then they'll give to you. Now, in the top-down approach of budgeting, senior management will set the budgetary targets for the organization. And this approach is mostly a time-saving technique because of what? The inexperiences of staff, a whole lot of competition, and a whole lot of inefficiencies, right? It is fast, but it also has its disadvantages, right? People become apathetic, dysfunctional behavior, right? These all are mostly covered under the behavioral approach of budgeting. Now, with the bottom-up style, managers are required to draft a budget for their area of operations, and these are submitted to their superior, and eventually it becomes part of the budget for the whole organization. Now, this is more time-consuming. However, this will reflect the various views of the managers and will help deal with operations and help encourage what? Motivation through participation, because if you are told to go and draft a budget, bring it for me to review, you feel what? Motivated, because I've engaged you in the decision-making what? Process. So please do not forget this. Now, what are the objectives of budgetary planning and control? Mostly planning and controlling goes together, because when you plan, you must set procedures in place to see whether your plan has actually been achieved. The objectives in your plan have been achieved, right? That is the process of what? Controlling. Now, budgetary planning and control will help what? Achieve the organization's objective, because we establish a plan, so we work towards it to achieve, not so. And when you control, this is also to achieve what? Whether to check whether what you said has actually been achieved. And this one will force people to plan, right? That is it. It also helps communicate ideas and plans. It can help coordinate activities. Okay. It can also help to provide a framework to help people account for what they are supposed to do. So if I was in charge of sales and I said, this is what I'm going to achieve, it sort of brings about a framework for what? Responsibility accounting. It can also establish a system of control, because I can check my budget against what I actually achieved, and it can help motivate employees to improve their performance. Not so. It can also be used to what? Evaluate employees' performance. So these are the objectives of budgetary planning and control. Now, we are saying that yes, budgetary planning and control. Now, anytime you want to plan, there must be a control procedure ahead. Why? Because when you plan, you must check and see whether your plan is what? Being achieved. So we have the planning and control cycle. And under planning, you first identify your objectives. Then the next thing is that now that I know my objectives, I'll gather data, then I'll identify alternative courses of action, that is strategies which might contribute towards achieving my objective. Then now I look at each of the strategies that I have adopted. Then I choose a particular strategy or an alternative course of action. And then I implement the long-term plan in the form of the annual budget. Are you getting it? Then comes the control process. So after you have been able to identify that objective, You have identified strategies to achieve the objective. You evaluate each strategy and choose the best one. You now put people to work by implementing it, right? Once you have been able to implement, you need to measure the actual result against what you planned. And then you respond to divergences from the plan, which we call variances. So definitely, if you said at the end of the day, you produce 5,000 soaps and you ended up producing only 3,000, what happened? Is there something we can do to get back to the 5,000 we planned next time or in the upcoming period? That is what the planning and control cycle is about. Identify your objective, suggest strategies to achieve it, and also evaluate each strategy, choose the best one, implement that plan in the form of the annual budget, measure your actual result and compare with the plan and respond to what variances or deviations from the plan. That's controlling. Measure actual results and compare with the plan, respond to divergences from the plan. Okay, so in the performance hierarchy, just like planning, we have the top level plan, middle level of planning, and the lower level, not so. The same happens to control. Control too can be at all levels, but let's look at planning in the performance hierarchy. Now, corporate plans, or what we call strategic plans, are prepared at the board of directors level, or what we call the strategic level. And this one is focused on what? Overall corporate performance. So it sets overall plans and targets for various business units and departments, right? So the board of directors will decide what each of you should be doing in your departments, the overall strategy, right? The overall plan is taken at the top level. Then we come to tactical plans, which is prepared at the lower management level, okay, or the management control level. So usually within a year, right? They plan for the individual department or activities within guidelines set by senior management. And this one provides a link between your strategic plans at the senior level and your operational planning. So if I have 5 divisions, right, and I decide plans for each division, that one is corporate plan. Now, under each division, there are various departments, right? Those departments need to also plan in accordance with my original plan, right? And that becomes tactical plans. Now, day-to-day junior levels, right? Those who buy stuff, those who go to the market, those who go to GRA, all those ones are day-to-day, right? So these people look at the operational running, the operational plan, detailed specifications of targets, which supplier to pay, which person to take money from. Are you getting it? So most organizations have long-term goals, which can be divided into objectives and action plan. So the objective is the measurable steps towards achieving your goals, and the action plan are the detailed steps for achieving that objective, which mostly we call a budget, right? A budget. So a budget is the organization's plan for the forthcoming period expressed in monetary terms. So sometimes they can ask you, ICA can ask you to distinguish between what? A forecast and a what? A budget. Now you must remember this. A forecast is a prediction of what is likely to happen. It may not happen, but a budget is a target, not a prediction, which has to be achieved. You get it? Any difference between planned results and the actual results are what we call what? Variances. A budget is not a prediction. It is based on data, right? A budget is based on data. Forecasts are not based on data. The data is not accurate like that of a budget. It's just a prediction. So please keep this in mind. Okay, so why do we budget? What's the main purpose of budgeting? Okay, so it is a list of all our planned expenses and revenues, and the purpose is to provide a forecast of revenue and expenditures, not so, to enable our actual financial operation to be measured against the forecast, right? And in order to make effective decisions and coordinate the decisions and actions of various departments, not so, a budget needs to have a plan for, a business needs to have a plan for its operations. Planning the financial operations of a business is actually called what? Budgeting. So budgeting has a lot of aims or a lot of objectives, which we looked at. It's still similar here, right? But I think we used to use crumpets to remember the objectives, or some people even use it for the same as importance of budgeting. So the C stands for what? Coordination. So a budget can enhance what? Coordination among various departments because they have to work together. Also, it assigns responsibility. Also, a budget can help bring responsibility accounting. We know, so each person knows what he's supposed to do under his various departments. Also, it helps in knowing which places in the organization that needs utilization of resources, right? So if I prepare my procurement budget, you know how much I actually have to buy. Also, then I think budget helps in planning. Also, we talked about that because a budget itself is a plan. Then we looked at what evaluation of what performance. Also, evaluation of performance. We talked about it that the staff maybe are you getting it? A budget can check what you presented against what you actually achieved. Then it helps in what telling or simply what communication, right? So these are the objectives, or simply they could ask you for the advantages of preparing a budget, and you can still use this to, go and, take advantage of the question that is being asked. Okay, so always remember this. Okay. Now, let's look at the budget setting process. The budget setting process. Now, before budget setting process is commenced, the long-term goals of the organization must be considered. And a budget is always set, taking account of what? Your organizational goals. So budgets are steps towards the achievement of your long-term goals, and hence budgets ensure progress towards the ultimate goal of the organization. So a budget starts always when you are setting a budget. It always starts with what the administration of the budget. So the organization will put together a set of instructions that will govern what each person is supposed to do. We call that a budget manual. Okay, so a budget manual is actually a collection of instructions that governs the responsibility of persons. It is usually prepared by the management accountant. So here, this budget manual will have the objects of the budget, the organization structure, guidelines regarding making your budget, format and layout of the budget of the organization, how the budgets depend on each other, and the budget deadlines. Okay, so all these things are found under what? The budget manual. Okay, so when you're administering a budget, you must have a budget manual as an organization. Then the next thing to talk about is what period does the budget relate to? So after you form a budget manual, or you put together a technical manual, right? Some people call it technical manual. Now you must know the time period to which the budget will relate, then who has responsibility for preparation of a particular budget. So your manual, the period for which you are preparing the budget, and responsibilities for preparing the budget. Then from there, I think we have to know people who check those who are in charge of the budget, right? Which is the budget committee. Now, the budget committee is usually responsible for coordination and the administration. So the putting together of all these manuals, and also the period and the people are all done by the budget committee. So most of the time, the members of the committee are the managing directors as the chairman of the committee, the accountant as the budget officer who gives assistance, and representatives or reps from each department. Remember, when we prepare our individual budgets, we usually consolidate them into a master budget, okay? And that is when this committee comes together. So what does the committee actually do? ICA can ask you this, right? So one, they coordinate for budget preparation. They issue timetables for each of the functional budgets, which are the budgets for each of the departments. Also, they can help assign responsibility for the preparation of the budget, provide information which is required for the budget. And also, they help communicate the final budget to appropriate managers. They can also help in variance calculation and investigation, and also continuous assessment of the budget process. So once you have been able to administer the budget, the next step is to prepare the budget. Now, we do not just prepare budgets. We do not just prepare budgets, okay? First, we must communicate the details and guidelines to the person who is in charge of the budget. Okay, so if it's the sales manager, it's the sales manager we communicate to. But the next thing, which is very, very important, is that you do not just budget. I told you a budget has mostly accurate data to determine the budget, right? It has statistical evidence. So we are saying that, okay, before we prepare a budget, right, we need to determine what we call a principal budget factor. Since we have done limiting factor decisions, a principal budget factor is actually the factor that limits the organization's activity for a given period, right? So most of the time in questions, it is usually the sales demand. Okay, it is usually the sales demand, but that doesn't mean it is the sales demand all the time. Assuming that, okay, if I produce 50,000 units into the market, customers always buy 50,000 or even ask for more, then this might not be my limiting factor, right? But maybe if my production hours are short, right? Maybe I need 10,000 hours to produce, but I only have 8,000 available, then I could say that what the machine hours becomes what my limiting factor. Therefore, that becomes what my principal budget factor. If that is the case, then I must start from this what I must start preparing the budget from my production budget, because the production hours are short, right? But most of the time it is sales demand, because you do not know whether if you produce 50,000, people buy 50,000, right? So let's say that if I produce 50,000, people can only buy what? 40,000. That means that I'm limited, right? I cannot produce and sell 50. That means I must limit myself to the 40 and use it to prepare all the other what? Budget. So once you have been able to identify the principal budgeting factor, then you can use that to start your operational budget or your functional budgets, right? So budgets are prepared according to your various departments. After that, the committee comes together. We put all the budget together into a master budget, which mostly is made up of your P&L, your balance sheet, and your cash budget. Okay, so very, very important. Make sure you remember this, and I think you shouldn't have a problem. So that is it. Now, it is often the starting point in the budget preparation, which is your principal budget factor. It is also known as the key budget factor or limiting budget factor. Usually it is sales demand or any limiting factors are explained, and all the other budgets are dependent upon it, because once you know where you can start. Then after that, we prepare a budget of the principal budget factor first. Okay, so if it is sales demand, then we must prepare our sales budget. Then from there, we come and prepare our functional budget, also based on the sales units that we have. So we can prepare production cost budget, our resources budget, capital budget, machine budget, material, labor, overhead, marketing, personnel, anything. Every budget can be prepared. So once we prepare budget for each of these activities, we consolidate them into a master budget. So the master budget includes the cash budget, which shows the anticipated sources and use of cash for the forthcoming budget period. And also, short-run deficits and surpluses are identified to enable the appropriate action to be taken. Then we have the budget income statement, the budgeted balance sheet. And also, after we have been able to prepare both our functional and master budget, we must negotiate budgets with our seniors for them to approve what we have come up with, right? Then after that, we coordinate the budget, because some budgets are out of balances with others and need modification. So maybe if you are telling me that you need to produce 5,000 units, and then you go and look at maybe labor budget, and labor budget is saying that only 8,000 units, right? That means it does not correspond. They are not coherent. So you need to go and make sure that you coordinate, right? Each of them work together. They must sync, right? Each of the various departments' budgets must actually sync, right? Once you do that, then we finally see whether management is going to accept the budgets that we have created. Okay, so acceptance means that the budget becomes a formal authorization for all levels of management to take action for and behalf of the company, right? So please remember, from the administration of the budget to the preparation of the budget, to the negotiation, to the coordination and the acceptance, right? So remember, your administration, the budget manual, and also the budget period, the people responsible for the budget committee preparation, your principal budget factor, and also your functional budget, your master budget, negotiation, coordination, and final acceptance of the budget. Mostly that's where it ends, but sometimes some organizations do budget reviews, right? So once we do the master budget for the whole organization, we assess whether the budget, we have resources to carry it out. We call it feasibility. Then finally, whether our stakeholders are going to accept the budgets that we've put together, right? Remember, to maximize shareholder wealth is the main objective of the organization. So once completed, the budgeted financial statement and cash flow statements can also be prepared, right? Which are all master budgets. So basically, this is the first part of budgeting, which ICE wants you to know about. Now, the next part of budgeting are the various budgeting systems, okay? So the first system of budgets I'm going to talk about are fixed and flexible budget. Now, a fixed budget is what we normally see in questions, like when they give you budgeted units, 30,000. That is a fixed budget, right? So a fixed budget is a budget which remains unchanged regardless of activity level, right? So if I have 50,000 units with some figures and this remains the same, irrespective of whether activity changes, right? This is a fixed budget. It doesn't change. So it is prepared based on an estimated production plan at the start of a period. It does not give like with like comparison and commonly used in service industries because in the service industry, most of the time our costs are fixed and it does not give fair performance evaluation and it is normally prepared only for planning purpose. Please remember this. But when it comes to flexible budget, right? This is a budget that flexes the budgeted level of cost and revenues according to the level of activity actually achieved. Mostly under ICA conditions, we prefer flex budget. I define a flex budget as a budget which has been what? Adjusted to reflect actual levels of activity. Okay. So mostly if you have prepared 50,000 units and you actually produced 100,000 units, you see, you cannot compare 150,000. So you have to flex the budget. You have to adjust it to also use 100,000 to what? Derive what? These figures that would be in comparison, right? So the budget is initially prepared at the anticipated level of activity. And the budgeted production level and the actual production level may not be the same. So budgets may need to be adjusted to reflect the actual production level. Okay. The new budget flexed to the actual production level is called the flex budget. The budget prepared on different activity levels is called flexible budget. So a flex budget is the one prepared at the actual level of activity. Flexible budget is the one that are in different activity level. So you see, we see questions, we are doing budgeting indirectly, but we do not know. You see some questions, they tell you that the person produced at 80% capacity. Then we go and find 70%, we go and find 100%. We are actually flexing, right? So it becomes a flexible budget. So for variance reporting, we use actual costs and compare with what? The flex budget for the same volume of production and sales. So the variance can either be what? Adverse or favorable. So appropriate control action is then taken to control the variances. Like maybe if it's adverse, what do you do to control adverse variances? Okay, mostly in simple terms, adverse and favorability of a variance is telling you whether you are what? Losing money or you are making more. Are you making profits? If you sell more, you make more, so it's a favorable variance. Let's say if you incur more cost, a cost variance, if you're incurring more, it's adverse to you because you are losing. This is one thing I want my students to always have in mind. So sometimes you have to think. So when you do the variance and you're interpreting the variance, you can think the same way you do ratios is the same way you do variance. So I have an adverse sales variance, meaning people did not buy more, or what I expected to sell, I sold lower than that. Then you see that the adversity of the variance may be due to what? The performance of the sales and marketing team. Maybe they do not do proper advertisement. Two, maybe a competitor came into the market. He came to steal all our customers. Not so. Maybe the units we plan to sell, we sold lower or we reduce our selling prices, right? That's how you deal with budgets. Management accounting should be so smooth and going if you know what you are doing is the right thing to do. That's always what you need to do. So mostly with a flexible budget, that is the approach you go with, right? So I am going to take a simple example to help you understand the concept of what a flexible budget. Okay, let's use Excel. So with a flexible budget, one thing we can do is let's take a simple example. So if we have prepared a budget, so let's say I have a fixed, let's say I have a fixed budget here and I have an actual budget here. So we are going to use this to prepare a flexible budget, right? So let's say the units produced and sold. So produced and sold. So let's say the units produced and sold. We produced 15,000. No, let's just use 100,000 here. We produced and sold 100,000 here. And here we produced and sold 200,000 here, right? Units. Please remember. Now, we are saying that if we are comparing two things, you cannot say, okay, if I'm putting revenue here, which one have we done well? So let's say revenue. We plan to sell what 100,000 units at and we had 1 million Ghana cedis. Also, here we plan to sell 200,000 units, but we ended up with 2.8 million, right? Have we done well or we have not done well? Somebody say, oh, we did well. It is not fair. The reason is because you do not have the same base. Remember, for management accounting, until you can compare the revenues, they might be at the same base. So you cannot say that, okay, this guy works in marketing, for instance, right? He's earning 10,000 Ghana cedis. Not so. This guy works in accounting and he's earning 25,000 cedis. Whose job is good? No one. We cannot tell because it depends on the role. They are not at the same base, right? Marketing is different from accounting. But what if this guy was an accountant in company A and he was taking 10,000, and this guy was also an accountant at company B and was taking what? 25,000. Then we can now conclude that well, company B pays well. Company B is doing better because now they are all accountants, right? So anytime you are given a budget and you are asked to prepare a flexed budget, what you are supposed to do is what? You have to reflect all of them at the actual level of activity, right? So this fixed budget must be converted into what? A flex budget. And that will bring us to the concept of flexing, right? That means you need standard cost. It's a standard cost that we use to prepare variances, not budget. So these ones are budgeted cost, right? This is budgeted cost, right? We must convert it to actual. So let's say this is our sales revenue. Let's say we have, so if that is sales revenue, let's say we have cost, right? So under cost, let me just make it very simple. Let's say we have material cost. No, so this one, the material was 800,000. And here the material was 720,000 or so. We had direct labor, okay? Direct labor was 400,000 or so, and this one was 480,000. Then we had variable overheads. So variable overheads, let's say variable overheads here was 500,000 and here was 600,000. This is what we have. Then we have fixed overheads, right? Fixed overheads. This was 800,000. Okay, they are all losses. And then this one was so let me just make this 80,000, right? So 80,000, and this one was 120,000. So this is what we had, right? And they are telling us what should be the requirement. The requirement should be to required prepare a budget useful for decision making. So we are saying that, okay, the normal budget that is given is not useful for decision making, but the budget we need to prepare should be one that is useful for decision making. If the company uses, okay, I getting A, an absorption costing system, right? So absorption costing system of management accounting, and B uses a marginal costing system. This is one thing you must understand, right? So each system will have differences. The only difference is that under marginal costing, there's nothing like what absorption of fixed cost. So if you see fixed cost, it will still remain the same, irrespective of the level of activity. And remember one thing, that cost behavior plays a key role in flexing. You remember there was a concept. I told you that what? Variable cost per unit remain what? Constant, irrespective of level of activity. If you have this concept with you, then it is easier for you to what? prepare a flexed budget, because you know all the variable ones per unit, they are the same. So you can just get a per unit and use it to multiply each unit. Are you getting it? So one thing you must also understand, which makes this very important, is that when we talk about what standard costs, okay? So all the time you need to find your standard cost per unit. And your standard cost per unit is actually what? Your budgeted, what? We've done this a lot. Our budgeted cost over your what? Your budgeted units or your budgeted level of activity. So if I give you what? This, so this standard cost per unit was similar to your OAR, right? If you are doing it for fixed cost. So you are actually finding some sort of what? Per unit figure, per hour figure, per whatever it may be. That is your standard cost we want to get. So with this information, what I can do is that I know that what? My revenue changes as level of activity changes. That makes revenue variable. So far as my sales are variable, then we can definitely get what? My sales per unit. So the first thing I'll do is get my workings. Also, I told you flexing means what? Reflect at what? Actual levels of activity. And my actual levels of activity is actually what? I actually produced what? Was it 200,000? Yes, I actually produced 200,000 units. But the budget was actually at how many units? If you look at this, the budget was actually at 100,000 units, meaning it's not fair to compare 100 against 200. We need to get some number of units at the actual level, right? So if I want to get my selling price per unit, I know that my selling price per unit gives me what? I need a standard, right? So I must divide what? The total 1 million sales over our what? Our number of units under the fixed budget, and this was 100,000 what units. That means that my selling price per unit should give me a figure of what? 10 cedis per unit. That means, okay, this selling price is actually 10 cedis what? Per unit. Now, if this is 10 cedis per unit, then I know that this is the standard cost now. Is that not so? This is the standard cost. So if this is the standard cost per unit, then what becomes what? The flexed figure. What becomes the flex figure, which is at the standard, not so? The actual level of activity. So we are saying that, okay, this one is 10 cedis per unit under the fixed what? Budget, but then we actually produced 200,000 units. That means that this figure should have actually been what? 200,000, so that we know that all the units are at 200,000. The actual is also at 200,000. So we can establish what? A variance, right? Because all are now compared at the same level of activity. Let's go and get our direct material cost per unit, right? We know that direct material cost is what? Variable. So it doesn't change per unit. So once we get the per unit, we can also multiply by the number of units. So this one too, when we go up, we can see that the direct material was 800,000, right? Since it was 800,000, we have what? 800,000 cedis over the fixed budget, 100,000 cedis, right? 100,000 units, sorry. That means direct material is what? 8 cedis per unit. Since it is 8 cedis per unit, if I want to get the flexed will give us what? The 8 cedis per unit times the 200,000 units, right? And 8 that is about what? 160,000. 4 said 8 by 200,000. That's 1.6 million, sorry. 10, oh, this should be 2 million. Sorry. This is 1.6 million. Okay, so we have 2 million for our revenue, and then what? 1.6 million. So when we go to direct labor, because it's variable, no, so direct labor, because it's variable, direct labor is still the same. How much was direct labor? We can say that, okay, direct labor was 400,000, so over 100,000, which gives us 4 per unit. So direct labor was 400,000 divided by what? 100,000 units. And that gives us what? 4 cedis per unit for direct labor. So now that we've got this, then we can get the flexed amount for direct labor, and that gives us 4 cedis per unit, not so 4 cedis per unit times the number of units, which is what, 200,000 actual. So for flexing, you always reflect it at what the actual level of activity. And that means 4 times 200, that gives us what, 800,000 cedis, right? For direct labor. Then we go to variable overhead, right? So for variable overheads, the cost for variable overheads in our scenario here was 500,000 also. So since it was 500,000, all we have to do is what, take our 500,000 and the same way divide over the 100,000 what units, also. And that means this one gives us 5 cedis per unit. And if 5 cedis per unit, the flexed amount for the variable overheads should be 5 per unit times the number of units, which was what, 200,000, and 5 2, that also gives us what, 1 million Ghana cedis. Okay, so this is the expected. Now this is what we should have expected, right? So we now come to our fixed costs. Now, one thing you must understand about fixed costs is that if you are doing absorption costing, then actually you need your OAR, right? And our OAR is just what? Here we didn't have any hours. So our OAR will be what? We know it will be our total what? All what we are doing is still OAR, right? Our total budgeted what? Overheads over our total what? Budgeted level of activity. So in that case, we need to get what? Our standard. And our standard is our OAR. And looking at this question, the fixed cost per the budget was 80,000 cedis. And then we know that what? It cost us, or we produce 100,000 units. That means this gives us what? 0.8 cedis per unit. That becomes our OAR. It was per unit. But you must remember that if it was marginal costing, okay, then we can't have this. Marginal costing, we can never have this. Okay, that means that if we are flexing, here I assumed absorption costing, right? So if you are doing flex and absorption costing, then you need what? OAR, then you use it to flex, right? So our flex is just what? 0.8. This is per unit. So you multiply by the number of units, which was 200,000, right? Actual. So 80% of 282, that's about what? 160,000 also. Okay, so this becomes our fixed overhead cost. But then when it comes to what? Marginal costing. So marginal costing, remember, under marginal costing, all fixed costs are considered as period costs. So since they are considered as period costs, we incur them from a period. So we can't do this, no absorption. That means that the budget fixed cost, which was 80,000, right? Because we do not absorb, that means our what? Our flexed figure should also give us the same 80,000, because under marginal costing, we do not absorb. This is the only difference between marginal and absorption cost. And apart from that, anything works, right? So perhaps it's any fixed cost. So it may be depreciation, it may be rent, it may be anything. You just replicate them. You just what? Bring the same, because level of activity, irrespective of whether it change, fixed cost remains the same, unless it's a semi-variable cost. They can bring semi-variable costs inside what? A flexed budget, where you have to split the fixed and the variable part, right? So that you know which one is per unit, is fixed per unit or is changing per unit. Most of the time we call it a budget cost allowance, but don't worry about that. Since you know how to use what? High-low method, you shouldn't have a problem. Once you see things like maintenance, you see things like insurance, you see things like electricity, water, you know that they are semi-variable. Just look for 2 periods, look for high and low, and then use high-low to split. Okay, so this is basically it. Since we have been able to get all the costs that we need, we can prepare what? Our flexed budget. So what I'll do is that I'll just create the flexed by the site, and then you create the variances. Mostly that is what you do. And you only need the actual and the flexed only, right? That's how you do this. The actual against your flex. You can create it in between, or by this side. That's what I'm going to do so that I will not, so I'm just going to create the flex and the variances by the side. We just pick the figures, then we notice whether we are going to get what? An adverse variance or what? A favorable variance. So mostly what I do is that I draw a line in between the what? The actual and the fixed budget so that I could say that what? These two are completely different, right? Then I come here and say what? The flexed is also at how many units? They also at the same 200,000 what units, not so. Then I bring my Ghana cedi. Then this side will be my variances, right? Then I bring Ghana cedis. You see now we are comparing 200,000 units against 200,000 units. Now it makes more sense because they are the same level of activity. So when I go to revenue, how much was my flexed revenue? It was 2 million. Okay, so we anticipated to spend what? To earn 2 million revenue, right? Your flex is actually your budget. Remember, the flex is a flexed budget. Meaning this now becomes our actual budget, right? This is now like the budget we should have used. So we've corrected the wrong one. And now we've got our new budget. So in our new budget, we expected to earn revenue of 2 million, but we earned 2.8. Have we made a profit? Would this increase profit or reduce profit? It will increase profit because actually we sold more than we expected, right? By how much? 800. So we earned about 800 more revenue. So it's a favorable variance. Okay. This is what it is. This is all you have to do. You compare the flex against what? Your actuals. So let's go to, you see, I completely ignore the fixed budget because I don't need it again. I only need the flex budget. So in that case, I go to what? Direct material. And direct material, when I come to the flex, there was 1.6 million. So I'll just go and insert what? 1.6 million. So 1.6 million. No, so it's a cost. So these are costs. So when we come to material, we realize that, okay, we were expecting to spend 1.6, but we only spent 720. So we spent less than we expected. So we've saved costs, right? So will this increase or decrease profit? It will increase profit. So it's a favorable variance. So by how much is the difference? So 1,006 minus 720, that means what? We have about 880,000, also what? A favorable variance. Also, then we go to direct labor. When you go to direct labor, you realize that direct labor was 4 cedis per unit and the actual unit produced is what? 200. So we incurred what? Cost of 800,000. So for direct labor, we expected to spend 800,000, but we ended up spending what? 480. The same way we have saved cost, right? So 800 minus what? 480. That means we saved about what? We actually spent less than we expected to spend. So we saved about 320. This is also what? A favorable what? Variance. Also, then we come to variable overheads. It says what? We actually spent 600,000, but we were expecting to spend what? How much for variable overheads? 1 million. So that one was also favorable. So we were expecting to spend I think 1 million, but we ended up spending what? 600,000. That means we have saved about 400,000 also. So this is also a favorable variance, right? That's how you look at it. Okay. So let's go to our fixed cost. Here, I'm just going to use the absorption costing one, right? So we're expecting to spend what? 160. But how much did we actually spend for fixed costs? 120. The same way, we're expecting to spend what? 160, but we ended up spending what? 120. So if you are going with what? Absorption costing, then you see this one, we flexed it. But when it comes to variable costing or marginal costing, the fixed cost could have been what? The same 80,000. You get it? So please do remember this. So in that case, this one too will be what? A favorable variance, right? Which will be what? About 40,000, also favorable because we ended up spending lesser than we anticipated. Okay, so that's how you go about it. But here we need our profit, right? Because I'll teach you how to also reconcile the profit. So if maybe we decide to use absorption cost, marginal costing, then this will no longer be what 160 because the fixed costs will not be absorbed. It will still be the normal 80,000 under the fixed budget because it won't change. So let's just establish, actually, when you are doing profit reconciliation, right? The profits that you see are just the standard and the actual. So the standard is what they call the budgeted. Okay, please don't forget this. So in that case, let's see if we can reconcile the profit. So if we have 28 minus 720 minus 480 minus 600 minus 120, I think this one gives us 880,000 Ghana cedis actual profit. Then this one we have 2 million minus 1,006 minus 800 minus 1 million minus 80. This one gives us a loss of 1,480, right? 1,000 loss. Now, there's an approach or a format for reconciling profits under this, right? So under flex budget, when you want to reconcile profits, there's an approach that we do, okay? And most questions will always tell you to reconcile profits. And if you want to reconcile profits, what you have to do is that once you take your budgeted profit, right? Once you take your budgeted profit, which is actually your standard profit, right? Which they are going to give you. So you are going to take your budgeted profit. So mostly you bring all your favorable variances and all your adverse what? Variances, right? Then your total. That's what you do. So most of the time you take what? Your budgeted profit, not so. Then what you do is that you add, let me just wipe this and bring it down. So you add all your favorable variances and less all your adverse variances, and you should get the figure that you want, right? That's the approach. If you know this approach, then you should be fine all the time. So in that case, with this, I'll start with what? My budgeted profits, not so. So I bring my budgeted profit. Then I put it there. Then I add all favorable variances. So I add favorable what? Variances. So if I have favorable variance like sales, let's say sales variance was favorable, I add here. Maybe material variances, not so. Material variance was what? Adverse, maybe I bring it here. Labor, maybe labor variance was favorable, I bring it here. Variable overhead variance was adverse, I bring it here. Maybe fixed overhead variance, not so, was also adverse, I bring it here. When I finish, I put all together, not so, I put all together here. So let's say this resulted in a negative, adverse is negative. So this, you add this, and that gives you what? The total sum of all your variances, right? Let's say this resulted in a net adverse variance, then you add it, then the final figure which you are going to get becomes your actual profit. Okay, that gives you your actual profit, which has been given per the statement, or if it is not there, then you could have prepared it, right? Which could have been prepared by you. Okay, so most of the time, some questions will not give this to you, but you would have actually prepared this. So based on our scenario that we have, think let's just go and capture all the figures together with the variances we have. I think if we go here, we know our budgeted profit is loss of 1,480, right? So what we can do is that when we come here, reconciliation of budget to actual profit. So reconciliation of budget to actual profit. Reconciliation of budget to actual profit. So in that case, what we can do is that I will bring my all favorable variances here, all adverse variances there. Then I bring my Ghana cedi here, Ghana cedi, okay? So when I bring my budget, my budgeted profit, which is actually the standard also. So my budgeted profit was 1,480,000, which was a loss also. So all I'm going to do is that I'm going to add or subtract my variances, right? All my variances. So in that case, I have sales variance, right? When I take my sales variance, how much was my sales variance? My total sales variance was actually worth what? I think we have to scroll up to see what our sales variance was. So our sales variance was worth 800,000 favorable. So I added to it, right? So I'll go to sales variance and just put it under favorable. 800,000. Also, it was favorable. Okay. So it's an addition, right? Add. When we go to material was also favorable. I think all were favorable except the fixed overhead when under marginal costing. So we have material 880 with labor 320. So we have material variance. So material variance was what? A positive 880,000. It will come and add. Then you go labor. I think labor was 320. So come to our labor variances. So labor variance, we had what? A positive 320. We have variable overhead variance, which was what? Also a positive 400,000. And then we have what? Fixed overhead. So with fixed overhead variances, that gave us what? An adverse of what? 40,000. So that one comes here as an adverse. When you are putting all your variances together, this is how you go about it. So this is how I will put all my variances together. So I have what? 800,000 plus 880 plus 320 plus 400. So that gives me 2.4 million. No, so then this 40 is a deduction, right? It's 40, a deduction. So in that case, what are we going to have then? So 24 minus 40. That gives me 2,360. So my total variances amounted to 2,360,000. So if I add this to that, I should get my actual profit. And it should always amount to your actual profit actually, right? So this minus 1,480, that gives you what? 880,000. And that should be exactly what you got for your actual profit. So let's check and see. Our actual profit, did we get 880? Yes, we did. This is it. So we have been able to reconcile what? This to that. So all the time when you get questions like this, that is how you have to go. Unless they ask you for profit reconciliation, if they've not asked you, don't go and reconcile the profit. It's not required. But most questions can tell you to do a reconciliation, and that will require you calculating all the variances and then reconciling them. Okay, so this is the first budget system, which is the flexible budget. But one thing you should also remember when it comes to flexible budget is that I told you it depends on cost behavior, right? So far you see that you must be very good with cost behavior. Always cost behavior is important under what? Flex budget. One thing you need to remember is that yes, you'll be dealing with variable what costs. You'll be dealing with fixed cost and their behavior. Remember, fixed cost and absorption costing, we absorb using what? OAR. If only you are using absorption costing. Under marginal costing, fixed costs are period costs. They are incurred for a period. So there's no need absorbing. Remember this. Then there's a concept of step fixed costs. They can tell you that if level of activity exceeds some level, okay, if your level of activity exceeds some particular level, you are going to incur what? An additional cost. So please remember, very important. Then 4, semi-fixed or semi-variable cost, right? Or simply what? Mixed cost. And this one, remember, you have to use high-low to calculate, right? Remember that this semi-variable cost is the same as your total cost. So where you have total cost, we know this is what? Your fixed cost, which is fixed, plus what? Your variable cost per unit times some number of units. Not so. Always remember this. So this one is what we write as A plus what? BX. So remember high-low. All the time you use high-low to split this. Also, sometimes the question might give you the level of activity as a percentage. So they'll tell you that the company is operating if company A, are you getting it, is operating at what? Operating at what? 80% what? Capacity also, and has the following cost. So maybe they are going to give you the following cost, right, at 80% capacity. So they give you revenue being maybe 200,000. They give you cost of operations, and then they give you variable cost, also all the variable cost being 180,000, and fixed cost being 10,000 also. Okay. So they've just given you this information. That means we have 10,000 to be our profit. Very simple question, right? And ICA can come at a different level. So this one gives us our net worth profit, right? They are telling us that this one is at 80% capacity. So they are telling you that one, prepare the estimated what? Estimated profit, also, for the following levels of activity, right? So one, 75%, two, 85%, not so, and then they will tell you that maybe three, maybe 90%. Okay, so they can give you a question like this, and once you get a question like this, they came with a flex budget at a percentage level. And that one, how do you do? Now, remember that I told you that anytime you have 80, find 100, and 100 is the same as 100 over 80 times what? Times the figure that you have been given. Let's call that figure y. So what do you do? So this is equivalent to just saying y over what? 0.8, remember, which gives you the figure. So since you have this, all you have to do is that you divide all this by 0.8 to get the original 100% capacity. Okay. So once you have the 100% capacity, then you can easily multiply by the percentage that you have been given to get each level. As simple as that. So what becomes my 100% capacity? So the first thing I'll do is what? I get what? My estimated statement, not so. I get my estimated statement at what? At 100% capacity, right? Because this one I've not been given the number of units to divide and get per unit and multiply. So at 100% capacity, all I can do is that once I take my what? My revenue, that means my revenue at what? 100% capacity will be what? That will be my 200,000 also divided by what? The 0.8. So, and that gives me what? That's 200,000 divided by 0.8. And that gives me 200 and what? 50,000. That's my 100% capacity. Then I less what? Variable cost. So let's say I've been given variable cost. So variable cost too, it was 180,000. So I take my 180,000 divided by 0.8, right? So that gives me what? 180,000 divided by 0.8. That gives me what? 200 and what? 25,000. Also, which becomes my variable cost. That means I have contribution of how much? Contribution of 250 minus that. That's about 25,000 also. Then I take fixed cost. So my fixed cost that was given also was worth 10,000 over 0.8. Okay, so 10,000 over 0.8. That means I can get my 100,000, that my 100% level, right? That's 12,500. So 12,500 means that my net profit that I was expecting should also be at what? The same what? 12,500. So now that I've got this as 100%, that means at 75% I can get, at 85% I can get, and at 90% too I can get. Simple, right? 75% means I'll just multiply the revenue by 75, everything by 75 to get the 75% level. As simple as that. Unless maybe there are some units I can get per unit, or just find all the number of units for all the levels and then multiply. By this one, this kind of question, when it comes, remember there are no units. So you are just basing on what is like ratio. If 100% is this, then 75 will give me what? I get it. So if 100 is 250, then 75 will give me what? As simple as that. So here, all I can say is that 75% times the 250,000. I get it. It's going to give me 187,500. So this one, that means the revenue is going to be 187,500. Then this one, I can just take the 250,000 also multiplied by 85%. Then I get revenue of what? You see, I'll just create it this way. Then all I can do is say that, okay, now I'll get revenue of 212,500 for this level, 212,500. Then at the 90% level, I just multiply by 90%. I have 225,000 also. Okay. So I come to what? Cost, variable cost. At 75%, I just multiply by 75,000. And then I have 168,750. No, so 168,750. Then this one, I'll just have to multiply by what? 85%. I have 191,250. Okay. 191,250. Then this one at 90%. So if it's at 90%, I get 202,500. So 202,500. So this is what I have. Then I get their contributions. I have 187,500 minus 168,750. I have 18,750. So then I have 212,500 minus 191,250. I end up with 21,200 and what 50. I have 225,000 minus 202,500. I have 22,500, 22,500. So now that I have this, I can easily get the fixed cost. Since I know that 100% is 12,500, and fixed cost does not change. You see, this is where you have to be careful. Here I'm using marginal costing. That means I cannot absorb fixed costs. If I can absorb, then I could be doing 75, 85, and 90. But here I'm not absorbing, meaning fixed cost will remain at 12,500, 12,500, 12,500. Here, the reason why I did the 0.8 is because I wanted to find the original fixed cost. However, the fixed cost I shouldn't have done over 0.8. It should have still been 10,000 throughout. I thought we would do absorption, but here I decided to use marginal cost. If absorption, the fixed cost would have been 10,000 throughout. But here I'm just assuming the 12,500, right? So fixed cost stays the same, irrespective of level of activity. Since they haven't told us that what level of activity is changing, then it's still the same. So in that case, what we can do is that now we can get what the net profit for each level that they have suggested. So this is another way flex budgets can come. So since the start, all we have been doing with cost behavior is that we were flexing, right? So this one is a flexible budget. But the one we did earlier was a flex budget, the one that involves you calculating what the variances. So this is the first system of budgeting. And then I hope you will go through this, practice more, solve more questions, and then you should be fine. Okay. So that brings us to the end of this session. In our next session, we will continue with the budgeting systems.